Well, today was a day to remember in a September FOMC that we won't forget soon. And to break it all down, we have Jim Welsh from Macro Tides. He's with us today. Jim, how are you?
I'm good. How about you?
Good, good. We're fresh off the FOMC.
Yep.
I know you brought slides. We're going to talk about the dot plots, and then we're going to see how you see the markets from here. But I thought, and I just want to say this really quick off the top of my head. I thought it was really interesting. Most of any bank or anybody doing analysis on what they expected out of the Fed expected not only Stephen Moran to be a 50 basis point dissenter, but Bowman and Warsh, Kevin Warsh, is that correct?
Waller.
Waller, excuse me, and Kevin Waller. But
I
we
said Chris
didn't,
Waller.
but we didn't get that. And
No.
I found that really interesting. I thought they were gonna. These are we're gonna be people that were really gonna push the envelope towards more rate cuts. But that's what I found interesting. Even though obviously the market didn't find anything interesting. I think we opened the day around 6,600. We closed the day around 6,600 in the S&P. So, what are your
Yeah.
thoughts just off the cuff with?
Well, I think you focused on something important because I thought the vote would be unanimous. I guess I thought that Merriman would be willing to kind of express his views, but then go along. And of course, that was wrong. He did dissent. I thought that Waller and Bowman going along with the quarter point cut and not dissenting there was more behind that in the sense of them saying we stand with Fed independence. So they wanted to show, if you will, a united front in terms of we all agree. And this, for a month ago, I was
That's
saying
that's
my
that's some
book,
great insights, Jim. That's great insights there.
well, my take has been over the last month that I thought they would go to 25, that you had people who were reluctant to cut in July. You had Waller and Bowman who wanted to cut in July. And I thought that what would happen is they'd agree on the 25 basis point cut at the September meeting. And that's pretty much what we got. We got the new guy on the block talking about a 50 basis point cut. That's what he wanted. And then on top of it, he wants another 125 basis points between now, October and December. In other words, a 75 basis point cut and a 50 basis point cut. And so to me, and Powell was asked that question. There wasn't much support for a 50 basis point cut. It was a nice kind of a slap down of that point of view.
Sure, of
And the other
course, yeah.
thing, yeah, so to me, that was the takeaway is that the traditional members of the FOMC and the board came to an agreement, and other than one lone wolf, it was a unanimous vote to cut 25 basis points. And, I think it speaks volumes.
Lone wolf in the hen house.
Yeah. Yeah. I mean, it's outrageous. I heard David Verbos or whatever his name is.
Zervos, Zervos.
Zervos. Well, Verbos sometimes isn't a bad miss.
No, it's not a bad way
He
to
wanted
describe it.
75. And I'm like, what are you auditioning for Trump or something? Come on, give me
Well,
a
he
break.
is, but he is.
Yeah.
He is.
No, but I mean,
We all know that.
we've been talking about this. On the one hand, you have inflation at 3% and likely headed higher. On the other hand, you had job revisions. And my point has been, I think people are overreacting to the job revisions because their history, and even those jobs weren't there, the economy was okay. Yes, it slowed to 1.2 in the first half, but a lot of that was statistical noise because of, pre-buying before the tariffs, big trade deficit, then plunging. The Atlanta Fed, as of yesterday, their estimate for Q3 is 3.4%. And the New York Fed's above 2. So my point is, I just think people have overreacted to those revisions. Those jobs never existed. And so now we're taking them away. And people are like, oh my God, the labor market's so much weaker. I just think that was an overreaction. And I think if we look at the dots and everything else, they're taking this one meeting at a time. Powell even referenced that. And if the next employment report comes in a little stiffer and the CPI ticks a little higher, I think it's what's going to happen at some point is the certainty that we're going to get cuts in October and December at some point in time, I think is going to be challenged. And the markets will react if and when that develops.
All right. Well, Jim, I know that you brought some charts for us to cover. We're going to still continue to talk about the
Yeah,
FOMC.
yeah.
I still think it
Yeah,
was
we're
a really interesting
circling
meeting.
back after we go through a couple quickies.
Sure. So let's get to it. The first chart you brought was the CPI. Why even what does this even matter? We got PCE next week.
Yeah. Well, my only point in showing this is that the year over year was 3.1, which was pretty much, right in line. But if you look at near-term pressures, month over month was 35 basis points. You analyze that, and what is it? Like over 4%? The 3-month annualized 365. So my point from the Fed's point of view, what they want to see is the near-term rate of change below the annual, because that says inflation pressures are lessening. Instead, we got the opposite. Inflation is clearly intensifying.
All right. Well, then it's clearly showing up on that chart, and this is
Yeah,
your CPI also.
right.
So points there.
Okay, so I think the Fed, or pardon me, the Labor Department surveys about 90,000 different products that they measure prices. And what you can see is for many, many years, they only had to guesstimate about 10% or less. In the last few months, it's upward of 30+%. Last month, it was 36%. So Powell once famously said, "We are navigating by the stars under cloudy skies." So my point, when you see data like this, the CPI, and all of a sudden more than 1/3 of it is kind of guesstimates, it just cuts down on the reliability of the data that the Fed is trying to make important decisions on.
All right. Well, now here's another chart regarding unemployment claims. So
Yep.
what was this an outlier last week?
Yeah, it was. And I think we may have talked about it verbally, but I wanted to address it. So the weekly change was up 27,000. So this came out the same time as the CPI. And initially bond yields ticked higher on the CPI news because it wasn't good news. And then they came down because of the unemployment claims. Again, it was for the month, the first week of September, which included the Labor Day. And if you look at what was the unadjusted increase, 8,000. So sometimes these seasonal adjustments get messed up. And to me, this is one of those times. Also, there was bad storms in Texas, and Texas reported a 15,000 increase. So my point is we're likely to get data tomorrow morning that the unemployment claims are going to drop from 263. My guess is they'll probably drop to under 245. But there was this knee-jerk reaction to the headline that really overwhelmed the CPI number.
Sure. Now, you did bring something on retail sales.
Yep,
I mean, the consumer seems alive and well for the most part.
that's the conclusion. You say year over year up 5%. The month over month was up 6%, 0.6, pardon me. Well, I saw David Rosenberg posted something that for whatever reason, the seasonal adjustment for this past August was very large. And the raw unadjusted data showed that retail sales had actually declined by 0.5%. The other thing I'll point out is retail sales aren't adjusted for inflation. So a lot of the increase that we've seen in recent years, retail sales are up this much. It's companies raising prices. So in terms of, if you looked at it in terms of unit volume, it would not be quite as strong as the top line sales number. So again, my point is people react to this stuff. The seasonal adjustments are having a big impact on some of the numbers that people are making investment decisions, and in terms of the Fed, making policy decisions.
Okay.
So, I'm not going to say that the consumer is, on life support or anything like that. I'm not implying that. I'm just saying we have to be critical in terms of how we look at data and take it in without just accepting the headline.
Okay. Well, I'm not sure what this is that you just brought, but let's get into it. Oh, it's the SEP. Okay, got
Yeah,
it.
this is the SEP. Now, here's the interesting thing is if you look at the numbers in each category relative to June, so they actually increased GDP for the balance for this year to 1.6. And next year, to 1.8 from 1.6. They don't think the unemployment rate is going to change from the 4.5 they had projected in June. And now they think the unemployment rate next year will tick down. And you look at the PCE inflation, both measures, unchanged for this year at 3.31, and they ticked the numbers for 2006 up to 2.6 from 2.4. So if you were just looking at these numbers, you probably would have thought, I don't know, why are they cutting? They think the economy is going to strengthen, unemployment's going to be stable, and inflation isn't going to make a lot of progress to their target.
So we should cut 75 like Zervo said.
Yeah. Okay. Now the thing
That's
is
sarcasm. Sarcasm, people, just sarcasm.
We're making that. I know. You got to be clear. So look at the Fed funds projection at the end of 2025. It's 3.6, and that's down from 3.9 in June, and then 3.4 for 2026. So let's look at the next slide, which is about the dot plot, because that's where these numbers come from, is from the dot plot. And what the Fed does is you've got 19 people writing down numbers, and they come up with the median. So in this case, you have one person who didn't even want to cut today, but didn't dissent, all right, and doesn't see a need for any cuts before the end of the year. 6 other people agree, we don't need a cut. Then you've got 2 people with 1 cut from where we are today, and then 9 wanted 2 cuts. And then there's Mirren, 1 guy wanting 5 more cuts. So the point is they do the median. So where's the median? In this case, it's 9 for 2 cuts. So that's why, initially the market kind of like, oh, that's great. All right. Now the next slide, I went so far as to take each one of those projections.
Actually, I don't have that slide. Whatever slide you're talking about, I do not have.
Yeah. Okay. Then I'll just do it verbally. So on the summary of economic projections, it says 3.6 is the end number. But if you take each one of these dots, Blake, and extend it, one guy says no cuts. Well, that's one guy at 437. 6 people staying right where we are, no cuts. What does that equal? If you then average those, and I excluded Mirren because I think he's out in left field somewhere. If you take the other 18, the average of those 18 is 385. Well, in other words, if you look at it and so the median said 3.6, but that doesn't tell us really where the center of gravity is on the FOMC. The center of gravity is the average, and that's at 385, which is 1 more cut. So I think this is some of the reason why we saw markets pop initially, and then we saw, things sell off before coming back, because you got to buy every dip. But this, to me, again, getting underneath the surface says, wait a second, you've got these 2 groups, and, if depending on how the data comes in, there's a high likelihood you're not going to get 2 cuts. You're only going to get 1 more. And obviously, people are betting on 2. So anyway, I just
but
break that down.
So it's going to be interesting. Make sure you all stick around because we're going to see what Jim's looking at as far as equities go, because equity markets are still at all-time highs. I mean, what happens if they do have to switch gears a little bit and make those adjustments? Then does the stock market suffer because the dollar, as you're going to point out, actually had a really hell of a nice rally today off these lows.
Yeah. I mean, for weeks, we've been talking. As long as the dollar doesn't take out 100.25, the odds are it's going below 96.37. I mean, that's kind of been the position. Well, today, it spiked down to 96.21 and then reversed pretty strongly.
We closed at the highs.
Yeah. So, I think it bottomed today. So again, what does that mean? Well, the dollar was at 114.77 back in October of 2022, and it's gone through what almost is a 3-year correction. And I think that 3-year correction ended today. And I'm glad you're circling that, because although the dollar made a new closing low yesterday, relative to where it was when it hit that intraday low at 96.37, you got a pretty nice RSI divergence where it's kind of saying, just visually, you can see a continuous decline followed by sideways. That looks like something that's building a base. In addition, when I go on Twitter, and I'm sorry, I don't call it X, I call it Twitter. So many people, the dollar's at this critical trend line, and if it takes it out, oh my God, the world's going to end, blah, 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 And I'm like, that's the perfect kind of stuff one would expect at a low.
Yeah.
People, the dollar's down 11%, and now you're worried about the sky falling? Where
Right.
were you back in January?
Right.
So to me, today's reversal, is kind of like, okay, that might very well have been it. And from here, the dollar's going higher. In the
Ooh.
next chart, drum roll. Oh, okay. I should have put the sequence different. All right. So gold, last week, what I told people is sell 25%. We got out at if you bought the breakout at 34.03, sell some at 36.50, sell another 25% above 3,700. It got a little bit above 3,700 yesterday, got a little bit more above 3,700, and then dropped, I think, about $47 into the close. So to me, I think gold is near at least some kind of a short-term high. Today in the Wall Street Journal, there was a story about, well, you should own some gold. Again, these are the things that show up after something has made a big move. So we got people worried about the dollar collapsing, and people like, okay, the Wall Street Journal, you really should have some gold in your portfolio. This is after it's gone from 1,600 3 years ago, or almost 4 years ago,
4 years
September
ago,
of
yeah.
22, to 3,700. Now we think you ought to have some gold. Why? Because everyone accepts it. Everyone's already, oh yeah, definitely. I'm kicking myself, and now you're telling me it's okay. So, again, I think the dollar making a low, the gold potentially making at least a near-term, short-term high, and then we're going to look at Treasury yields, and I think there's another potential trend change that has happened. So for a number of weeks, it was like, okay, I think we're going to get down to 407. A week and a half ago in the weekly technical review, I said, we could push 4%. This past Monday, hey, we're going to probably hang around here, maybe test 4% again. We did. And you have a 2-day key reversal in the 10-year yield. Made a lower low, higher high than the 2 preceding days. And it might actually be more than 2 days. We were scrambling a little bit to put all this together today. So to me, I think Treasury yields just bottomed. And over the last few years, the direction of Treasury yields and the dollar, there's been a pretty good correlation. When Treasury yields came down, the dollar was weaker. And conversely, when yields were going up, it was a tailwind for the dollar. Blake, I can't hear you, buddy. Blake, you're on mute.
My bad. My bad. I was
Okay.
going to say correlations have been, sorry about that. Correlations have been broken as of lately, but it's days like today that can really re-correlate a market.
Yeah. Yeah. I mean, these are kind of big moves on a day that the Fed said we're cutting rates, and the likelihood is we're going to cut more. And the dollar reverses strongly, bond yields reverse strongly. It's not what one would expect with that messaging and what people expected going in. They got pretty much what they wanted. Fed's cutting a quarter, and they indicated, based on the summary of economic projections, they're going to cut 2 more times. That's pretty much what everybody wanted.
Yeah.
So, to me, these are the days that are really kind of cool to be following markets because it's kind of interesting. And we'll see. I think bond yields bottomed, and my take is Treasury yields are going up. Obviously, getting above the most recent high, which was what, 435. I want to see
right there.
yeah, and then the 5, the red moving average and the green moving average. Now you want to see, okay, today was a nice day, reversal. Do we get some follow through in the next 3, 4, 5 days to the upside? that adds obviously weight and credibility to the assessment.
Well, tell me what's going to happen in the S&P because we are once again at all-time highs.
Yeah. Well, here's a chart. The high from January of 2018 connected to the high in January of 22. And we tagged the line the last 2 days or so. So are we going to break out or are we going to have a setback? And I think given what Treasury yields and the dollar, we're overbought. I think we're set up for at least a 3 to 5% correction. I don't think we're going to get a lot more than that. Blake, the advanced decline line made another new high this week. So it kind of just says, hey, over near term, we're overdone. And, we're hit a resistance. The RSI on a monthly, this is a monthly chart, shows a divergence. Well, you can see at the high in 2022, there was a monthly divergence between where it was in like October, November, and January. Going back to 2018, you can see the S&P made a new high, I believe it was in September relative to January, and the RSI was weaker. So these are all in the trend line. So to me, these are all the things that combine say, okay, today might have been a pretty important day in the S&P as well.
But, Jim, it's hard to say that when you're looking at the S&P that it's sold off. I mean, it went to 65.50. We sold off almost 50 handles, basically 50 handles rallied right back. And here we are. I mean, so it's hard to sit here and go, well, this is it. This is the top. I mean, from a candlestick point of view, today would have been a hanging man, perhaps.
Okay. I just don't know that part of the technical,
It'll work for you if we go down. How about that? It'll work for you if we go down.
Sure. No, again, coming back the way it is just keeps everybody very complacent and optimistic. It's like, oh, hey, buy the dip. It worked again. And so we have quadruple witching this Friday. So there'll be a lot of volume. I just think the weight of the evidence suggests, we were covering a lot of ground. I've talked about the semiconductor index. And on the back of Broadcom, which rallied, I think, 30, 40%, Oracle. So all of a sudden, the semiconductors looked like they were rolling over. And then those two stocks had huge moves. And the SMH went to a new high. RSI diverged. And so what more good news are you going to get in that sector, which has been the leading sector? And I think that's just one more chip in the idea that we're going to have a pullback here.
Well, Jim, let's see if we do. I want to say on behalf of the Traders Summit community, thank you for doing this a day early so we can get this out fresh, right after the FOMC. I know there's going to be a lot of people watching this tomorrow and taking it all in. What's the best way for traders to get a hold of your work?
Macrotides.com or send me an email, jimwelshmacro@gmail. I'll send you a recent report.
All right. Make sure you let Jim know that you're here from Traders Summit. And so this way you can give you a discount if you want to continue on with him. Jim, I want to say thank you. It's been great chatting with you today. And I'm going to look forward to catching up with you next week. And if you all enjoyed this interview, make sure you give Jim a thumbs up, subscribe to the channel. We do this every week, so you don't miss them every week.
Yeah. Great, Blake. Have a great.
Thanks, Jim. Have a great one. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.